Welcome to Xpandable by Fibonacci X. Xpandable is a series of conversations with investors, founders, and operators in India's early stage startup ecosystem, where we try to demystify the nuances of venture building. Today, we have Sorabh Agrawal from AngelBay, our guest, and also a strategic partner with Fibonacci X. Sorabh has 20 plus years of experience into investing, M&A, financial research. He's currently running a private angel network and advising startups and mid-sized firms on strategy, M&A, and fundraising. Sorabh spent a significant part of his career building and scaling up Copal Partners, which was a leading financial research firm delivering research and analytical services to clients across the globe. He played a key role in the sale of the company to Moody's Corporation. Sorabh holds an MBA from IIM Calcutta. Welcome, Sorabh, to the episode.
Thanks, Kulmani.
I think Sorabh and I've known you for many years. I think you didn't know me because I was very junior at that time.
I know you for at least 15 odd years now.
So that's a good thing, because I always thought that you didn't know me at that point. So that's a surprise. We'll start from the early phase of your life. How was it growing up? Maybe till you went to college and education wise. Maybe you start with that. Maybe some early life experiences which shaped your personality. And later some lessons which you carried with you when you went into the professional life from that.
Sure. So early childhood, I would say, has been pretty blessed for me, right? Coming from a middle class family, but again, we had ample of everything that's in. So we never got into a situation where we had something like a lack of something. So once you've got that kind of a easy life, building out, let's say, things on your own, plus let's say going to good colleges and having good education, I think my childhood that way was sorted. And once you come from that zone, chances are that at some point of time you meet a lot of guys who are inclined towards investing. And that might be the one of the triggers for me to get into investments. Plus, once you look at the positive side of the society where people are well-to-do and they are growing through either their hard work or their investments, you just tend to get a sense about how to do things in a good manner. And a lot of these guys unknowingly tend to become your mentor because they are shaping your life at the early stage.
Right. And any lessons which you carried from either your college education or your MBA to later in life about risk, let's say?
Right. It's actually, once you look at me currently, it's a culmination of a lot of factors in terms of education, plus, let's say, the kind of people I interacted, right? So education definitely had a big role to play in my early career or even in my late career. Because a lot of time when you are getting into investing per se, right? So till the time you don't really have the right set of tools or right kind of education, chances are you would start learning everything on your own, right? Which takes time. Sometimes you make costly mistakes, which may shake your confidence. In my case, I think again, I have been lucky to get the right kind of education. I did my MBA in finance, right? So a lot of those concepts which are slightly difficult for people to understand, I got to know very early on in my career. So I think I did have a solid education, which actually propelled me towards investment side.
Right. So one of the lessons which I carried from my college life into investing, because I was in the US for college, so I financed part of my education through credit card debt.
Oh.
And I learned about interest rates and what is the cost of missing any of the payments, and what is important needs to be done, right? So, and then initial probably doing minimum wage jobs, etc. So learned that lesson about what are the priorities and what is the cost of funding. Even before I knew cost of capital, I knew how do you manage personal finances, right? Because if I was at home and going to college here, I would not have to worry about personal finances that much, right?
Sure.
But that lesson has stayed with me, right? So I always I'm a little careful about what is your cost of capital,
right? So 2-3 things which actually probably I could talk about in my early days of life, right? So I never took education loan because my father sorted out the money for it. But yeah, obviously we could have taken a low cost education loan at that point of time, right? But my father, I think, had a big influence on me because he had all these LIC policies, his FD books, RD books, where he was trying to manage investment. So for me, coming from that kind of a family, investment was something which was anyway there. So I learned from my father. So for me, the investment wasn't something very different from early stage because you tend to become very comfortable with all this investing in case it runs in your family. Secondly, because my father focused on saving a lot because his salary wasn't that high compared to today, right? So we got the value of the product early on. So the idea was that in case you're going to college, what you need to see is that it doesn't strain the finances at home. So you actually became a lot more efficient in the early stages of your life, which carried forward in my investing style as well.
Right. So from fixed income now to venture, because that's I would say the other spectrum of risk return graph.
Right.
Right. You are the high risk spectrum. So how do you see some of those lessons now applying at in VC investing? Because here, as some people will call it, zero IRR investing, right? I mean, I don't agree with that. One of the things which I noticed about your approach to investing, and I think you also mentioned that too during your annual day, was that AUM versus ROI. You are not interested in growing the AUM, while you are interested in managing the ROI on your portfolio level, right?
Right. Right.
So I think that that's also a lot of people are looking for to grow AUM while you are looking to maximize ROI in that case.
Right. Yeah. What we feel is that because we are a private network, capital is always constrained. So we can't really just spread out our capital. For us, the ROI matters versus AUM in that case.
Right. And after your job, right, how did you start your investment journey? You were investing before, maybe in public markets, maybe in startups as well, but
Sure.
then you went full time into
Right.
venture, right? So how did that transition happen?
Got it. So it's a function of the kind of jobs I did. So initially, I started my career, post MBA career with Crystal. So there I got a sense about fixed income to a decent level because we were dealing to products like government bonds or let's say treasury bonds or even private credit and all that. And there you need to see that the check sizes were large. So
Right.
when I started my career in 2002, that point of time, a GSEC, a minimum lot was about 5 crores. Because the yields are so low that you can't really work on a smaller lot per se, right? So there you got a sense about how the high volumes can be done in the system. But then once I joined Copal in my last stint, there I saw other side of the world where it was investment banking, it was private equity. And there you realize that there I think the velocity of money is a lot higher in terms of let's say the kind of percentages you can make on your portfolio, and then you don't really need to play in larger volumes. So that thing starts becoming exciting because inherently, let's say, when you look at it, you tend to chase alpha or you want to chase a high return, which gives you kicks, right? So at that point of time, the fixed income market started seeming probably, let's say, less risky but flattish.
Right.
And you start getting enamored by things like private equity because there you see the percentages very differently.
Right.
And that attracted me towards private equity side.
Right. Right. So I think that's also something which investors need to understand is the risk return spectrum.
Sure.
Like which niche are you playing in, right?
Yeah.
Government bond may be a crowded market and low yield market because of safety and other issues. But a lot of people I see don't think that way, right?
Right.
So it comes down to mental models or developing frameworks, or you have those concepts clear or not.
Right, right. Secondly, I think I feel people don't experiment much in the financial markets, right? So for me, while I was working, because of a lot of restrictions, I could not have even traded in public securities. So most of my money was lying into fixed income products like your bond funds and all that.
Right.
Plus, let's say in equity mutual funds. Now, in that case, your money grows, but your probably the intellectual capital doesn't grow because someone else is managing your money.
Right.
So once I decided to leave the corporate job, first thing I did was I started dabbling into newer asset classes. So I got into equity, the public market equity. So I started trading directly just to see how things work. I went into from investment to becoming a trader in terms of doing intraday, which is slightly high risk, but again, the velocity is high. So you
Right.
start seeing how to scrape the money out of the table per se. So that was the second thing. Then I started dabbling into options and futures again because that's risky, but then the rewards are high. So once you start looking at multiple asset classes, then you realize that which asset class actually works with your temperament.
Right.
So you can make money anywhere, but in case you are worried about losing money, then potentially option trading is not for you. But in case you do 5 bad trades and still can sleep well, then probably come to option trading, for example. So
Right.
once I looked at all these asset classes, so private equity was another asset class which I dabbled with and somehow got the liking to private equity more compared to public market or options trading.
Right. And the thing with private equity, and VC is a subset of private equity, right? For all practical reasons, is it's very difficult to screen for targets, right?
Mhm.
Because in public markets, there's a lot of data available, and you can go out and do your own research. But when you talk about private opportunities, it's very difficult to find good opportunities before it becomes a trend or a fad where everybody is talking about it, right?
True.
So the recent fad, which I remember, let's say anything, let's say crypto or any other asset class, which is by the time you hear about it, there is no value left for the investor.
Sure.
Because if you're coming in at that point, it's already too late.
Sure.
So when you think about screening, let's say in private equity for startups or even mid-sized companies, how do you think about screening, right? Because now within private, obviously you could have a sector or other things. But as an investor, what are the criteria you are looking for when you're screening for opportunities?
So one of the things which probably I would say is that private market is not so opaque as people think it to be. The problem is people don't ask for information because when I look at any of my private companies, mostly the kind of information I have access to is better than the public market. Because once you are trying to invest into private markets, you need to really dig for information. Information is available to a
Right.
large extent. Now, in case information is not available in the company, then that's the company you should avoid anyway, because then you don't know what's happening out there. So once you get into these private information places, once you've got the information, it becomes slightly easier decision to invest in a private market, because the difference is that in case I'm buying probably a couple of crores of Infosys shares, right?
Right.
No one is going to talk to me about it from the company. But in case I'm putting in a couple of crores into a private company, I have got access to the complete top management to discuss and see how things will move, because then you get a feel about the company more.
Right.
And that is something I think which I find enriching in terms of having a much better kind of control on the outcome per se in a private market.
Right.
So for screening the companies, yeah, it's a hard work, because a lot of time when you talk to the company, their numbers are not clean. Right. So you need to figure out whether it's a clean number. So that's one positives of a public market, that a lot of information which you get tends to be clean and you can actually rely on that numbers, right? But in private market, you need to dig deeper, and a lot of time, because you are investing early on, a lot of it is your conviction about the segment as well.
Right.
Because the markets are very niche sometimes and there is not much research available. And even founders are somewhat clueless about how the company will shape up.
Right.
So a lot of time your experience tend to come into these kind of
Right.
companies for screening as well.
Right. And you mentioned about the management, right? The other side is that the future outcome is so much, high dependent. The dependency on the founder is extremely high, right?
Right.
So I'm sure when you are meeting the management, you're also screening them for certain traits or certain behavioral traits. So what are those positives or negatives about the founders?
Sure.
When you're thinking about potentially investing in a company, in a private company?
Right. So it's a lot more behavioral compared to probably technical.
Right.
So the founder needs to be ethical, right? So we don't do very heavy diligence on the companies, but in case we find anything which is not true about the company told by the founder, right? That's the point we exit or
Right.
we don't invest out there. Secondly, behavior wise, because that's the kind of founder you need to really work through for next 7 to 15 years, right? So behaviorally, the person needs to be courteous, right? So
Right.
we try to stay away from guys who are kind of arrogant,
Right.
right? So the whole idea is you want to make money, but the money making process needs to be positive for you. Apart from that, you need to see the management team, the top founding team you are interacting with, if they've got the right skill sets and the temperament. Now, temperament becomes a lot more important because running a large company is way different than running a very small company, right?
Right.
And even potentially can run a company which is doing 2 to 5 crores in revenue because everything is small.
Right.
But once you start getting into, let's say, lots of employee hiring, a lot of, let's say, cross-state GSTs coming in, lot many vendors coming in, how the founders hold up in terms of the growth of the company, because it's not easy to manage a 10, 20, 30 crores revenue kind of a company. So if the founders have the skill set, or at least that you see that there is a potential for these guys to run a large company, that's the point you want to get into that company. So a lot of founders probably fail at that test as well.
Right.
And then you need to see the fire, because once you're starting a startup, right, and the valuations are out of whack, right? For example, in case there is a company which is doing 100 crores in revenue and 10 crores and potentially PAT,
Right.
Public market will give them about 250, 300 crores in valuation. That's
Right.
a range, right? But if someone comes in with a 5, 10 crores revenue and asks for a 200 crores valuation, that's the point. A lot of it depends upon the founder's ability to scale. And that becomes the key criteria for us to see if there is enough hunger in the founder to grow to that level.
Right, right. So when you think about that potential, right? Let's say we're looking at founder A versus founder B. When you're making that judgment, whether
Sure.
founder A has that potential to, make it big, grow the business 100x or 200x, and also have the ability to manage the ops side,
Sure.
right? So what are those traits which you will look for when you talk about, that potential?
So mainly it comes down to maturity and experience, right?
Right.
Initially, we got somewhat carried away with the media narrative that there are two young guys just out of college build a billion-dollar company, right? Now, those kind of things tend to happen, but that's not the target set for us.
Right.
What we are looking for a solid, stable business which reflects in our portfolio. Now, for that, you really need the kind of founders who have seen or built something like that, either as an employee or as a founder before. Now,
Right.
once you have worked as an employee, the negative side, sometimes what we see is that people are dependent upon other persons to do the base work, right? So you are a VP in a large firm. So you do have a large organization managing your HR, finance, even your sales and all that stuff. Now, as a founder, you need to manage everything on your own. So do you have that drive to run everything on your own? So that's the flip side of go into the seasoned professionals. But over the last 8 years, right, what we have seen is majority of our winners have the founders who are experienced, and majority of the companies which we lost are the guys who have probably spent 4-5 years post college into running their startups. So this is not true for the general ecosystem because I did not do analysis. But based on my experience, that is what has happened in our portfolio. So naturally, our portfolio has now shifted more towards experienced founders.
Right, potential, right? Obviously, when you're meeting them, you're
Mhm.
asking them certain set of questions.
Right.
Okay, maybe about their past. Maybe you're also asking them questions which are very broad, nothing to do with to do with business.
Right.
Just to make sure that you understand what is their mental model, how are they thinking, how will they react in certain situation.
Right.
So what are those some of those questions which you like to ask? Not a secret sauce, but obviously the general ones.
There is nothing secret out here, right? So one of the things which I think I still believe is that we have got a segregation between a private and a public market.
Right.
But at the end, we are investing in a company, in a business, right? So whatever fundamentals which are relevant for a public company, generally the same fundamentals stay true for a lot of the startups, what we say, coming in the system, right? Probably maybe less than 10% of the startups are disruptive, right? Rest everything is probably basic level of work what goes into these startups, right? So out there, once you're looking for a lot of these, let's say, founders coming in and the qualities of what you look for in them, or the kind of qualities you look at in the business, that actually maps roughly with how you will evaluate a mid cap or a micro cap in the even the listed space out there.
Right.
Right.
And one of the things you mentioned was about young founders,
Mhm.
right? Um, well, one is the disruptive founders who are breaking a pattern.
Sure.
And another category which you mentioned was doing an iteration of an existing product or service,
Sure.
right? Uh, well, in the second one, there might not be some differentiation in the beginning,
Mhm.
but differentiation could also come through execution or something else which
Right.
is not visible in the pitch deck, right? So, do you take some bets like that as well?
Now, most of our actual bets, right, recently have gone towards the second kind of founders who have shown execution capabilities, because we might have looked at about 15 odd thousand companies over last about 8 years of existence, right? What we have seen is hardly probably a percentage point of the companies which we met have done something different or something which was like a wow factor, right?
Right.
Otherwise, everything is like a iteration of something or the other. So a lot of time now we are shifting towards looking at founders who have executed well, and that is actually reflecting in our thesis as well. So most of the time we look at founders who have done at least about 3-4 crores in revenue, because some spaces we can't even evaluate the technology or their
Right.
delivery, how can they deliver and all that. So once they've got paying customers who validate that the founders have the power of execution, that's the point we tend to get in.
Right. And when you meet these, now that you have so many data points, right, about even investments which have not worked out, do you think these founders had some blind spot, or it's just a matter of timing? Or do you see a pattern even with the young founders? Okay, these are some of the mistakes which are common
Right.
when you sit down and do your portfolio analysis for last 7-8 years. Are there any emerging themes on that part?
So something like we have stopped believing in something called timing out there, right? The founders who tell us that they were too early for the market. The problem is then you did not do your market research properly, or you weren't able to execute, right? So that was the factor which a founder needs to take into consideration as well, right? Now, in case your internet speed is like very bad and you're doing a tech business, obviously there are chances of failure out there,
Right.
which you should have baked in your risk assessment. Now, that can't be the reason for your failure because you already knew the truth. So for us, most of the startups which have failed are mainly because of the execution issues, because ideas whatever come to us, right? Most of the ideas will work. Even if you want to open up a laminate stand downstairs, right? It will work till the time you execute it well. So unless you're working on something which is path breaking, where you need to do a lot of iterations, a lot of, let's say, R&D, chances of you not being able to find the right molecule or right combination are high. But most of the businesses are running a iteration of something else, and there the execution becomes the key. So the failure is just because you weren't able to execute well.
Right. Now, do you think execution is something you have innate inside you, or this is something you can learn as a founder while you are doing it?
Execution, I think, is a process, right? So when I look at myself, for example, 20 years before, I would have failed in a lot of things. But once you start understanding the patterns and the processes, and you start following the processes to the T, chances are you will be able to execute, right? Now, in case you want to do the sales, like the thing in B2B sales is you need to just continue to follow,
Right.
right? In case you drop your lead after second iteration, then chances of you succeeding are low, right? So there are processes to the sales, and once you look at operations is a lot of it is process driven. So once your processes are set, and when I say set, it's an efficient process to bring the outcome out, chances of success go up heavily.
Right. And I'm sure since you're working with so many founders, right, you know the nuances of founder-investor relationships,
Right.
right? It can be a little difficult at times,
Yeah.
especially when the startup is going through a tough phase, or maybe they are going through a pivot, or switching gears, etc., etc. Right? And since you have been part of the early stage ecosystem for so many years, how have you seen that evolve, the founder-investor relationship?
Right. So I think maybe 8 years back, the relationships were a lot better because startups were less commercialized.
Right.
Right. Because what I feel or what founders should look at, you own 80% of the company,
Mm-hmm.
20% is with the investors. So you guys are co-owners of a particular company.
Right.
You want to succeed, investor also wanted to succeed. So there is no misalignment about the whole concept, right? Now there are differences which come in when founders start feeling that okay, there is a founder investor divide. Right now, that is like you guys are on the same side of the table, should be managed lot better. Now you need to communicate better in terms of, because a founder is someone who is the operating executive, right? So a
Right.
lot of information, lot of trust is on the founder. But you do have, let's say, 50 investors on your cap table or 30 investors on your cap table. These guys are there to help you out, but you
Right.
need to really give them information and ask for help at the right time. Now, in case you start doing these two factors, potentially, let's say, out of 50, 30 or 35 investors are not interested because they're just looking for money. But
Right.
15 investors will change your company to a large extent. But
Mm.
that trust and the ease needs to be there from both the sides.
Right. Now, I think because you mentioned 80-20, right? Usually at seed stage or pre-series A, or even before that, let's say at angel stage, usually the dilution is very, very less. So
Uh-huh.
that's different than if, within PE, you may have a controlling stake for a mature company as an investor, etc.
Right.
Right. So you think the dynamics are different when we're talking about early stage, because founders still feel that we are largely in the controlling position and these guys are enabling us, but still we don't owe them a lot of explanation.
Right. It's not about owing explanation out there, right? It's more about, you do have resources, right? You
Right.
do have investors as resources. Investors invested in the money because they believed in you,
Right.
right? Now, investors bring in money, plus they bring in expertise or connections, right? So that is something which is coming free to you. Now, if you don't know how to leverage that, then you can pick up money from anywhere. But in case you're looking for the good investors to come and work with you, you need to start actually getting them involved into the company.
Right.
Right?
Right.
Today, in case someone randomly calls me from HL and asks me for suggestions, right? Why would I give suggestions to them, or what do I think about it? But in case I have invested in you and you want me to connect you with someone or give you some kind of suggestions, I would be more open because now I own a piece of the company, which is substantial.
Right. So you're saying that on founder side, there should be some thinking put into when you are inviting an investor to come join you.
Right.
What are they bringing in addition to the capital which they're giving?
Right.
Right.
This is a fashion I have seen in the industry, that a lot of founders come to us that we are looking for smart money, right? Which means like we are looking for your expertise, we are looking for connections and all that. Once you put in the check, and believe me, 80% of those guys don't even ask you for your expertise or connections, right? Now that actually spoils the complete name in the market. The thing is, in case you are just looking for money, be upfront, you're just looking for money. But in case you do have expertise available and if you want to use it, right, then you need to leverage it, harness it. It's not going to come in directly, because I can't just get into your company and start giving you suggestions till the time I feel that you're receptive to it.
Right.
I can't open up my connections because I've seen multiple founders in my network who are looking for a deep connect into a particular company,
Right.
not realizing that one of the senior executives from that company is on their cap table. Right? So once you start harnessing, this is like a big problem which I see, that you do have resources, but you're wasting it out.
Right.
And there the dynamics actually goes for a toss. Now, one of the things which I feel is a big problem is we need to chase the founders for their quarterly reports. Initially, it was monthly, then we shifted to quarterly. Now, the problem is, in case you don't have your quarterly numbers, how are you running the company even? So those quarterly numbers are not for me. It's for you to actually see. Now, once you start sharing it with me, in case you're doing well, I'll applaud. In case you're not doing well, I'm not going to go and start screaming at you. For me, the problem is that there are certain problems in the company. In case I can help you out with business connections or probably managing the process, I'll help you out because
Right.
I am a co-owner of the company. Right? So those kind of dynamics needs to be managed a lot well.
Right. So I think in my past life, what I have noticed is that this part, value creation mindset, is very much, the framework is already set for the late stage companies, right? Because they look for, let's say, private equity firms who have expertise in a particular sector. They bring in their operating partners, they create value.
Sure.
Or they will typically make a 100-day plan. So I think on the mature side, it's already in place, right? But in early stage, I think people are still not realizing the potential of angels or HNIs or even syndicates which are investing into them.
Right.
And I think the reason is that they are even on the investor side, sometimes they are spread so thin, right? So they don't have that portfolio mindset. Okay, we have these 20 bets, and how can we maximize the probability of success for each of these bets?
Right.
Sure. So either it's too transactional, meaning they are busy with screening or busy with fundraising, but there's very little time which goes on at the portfolio level and engaging with the founders, right? And I think on founder side also, because they are young, that clarity and maturity is probably not there. So that's what I think. I think it's both ways. There is this little
completely agree. Yeah. To the founders' credit, I think there are investors who are somewhat on the difficult side.
Right.
And once you get a couple of those investors on your cap table, chances that you will speak to other investors will also go down, because then you start feeling that most of the investors are intrusive.
Right. And recently we have been traveling to cities outside Tier 1, right? So for example, we went to Lucknow, and then we are going to Bhopal. Before that, we did one event in Jaipur, right? I'm sure you have traveled to Tier 2 cities and you have lived in Tier 2 cities basis our conversations. Do you think the ecosystem, the startup ecosystem, is different in those cities versus Tier 1 cities?
Yeah, it's a lot more different, right? So when we talk about at the high level, right, there is a Silicon Valley and there is a non-Silicon Valley, right? The difference is that in a particular hub, everything is so accessible, so close to each other, like in Silicon Valley, right? So the chances of growth, chances of success increase tremendously because all the infrastructure is at one place. So once you go to Tier 2, Tier 3 towns, the problem is the ecosystem is not so evolved. Right. So out there, you do have a lot of opportunities lying there because the spending power of most of those guys is as good as Tier 1 cities. But then the way people actually act in those pockets could be a lot different than other pockets. So in some cases, you find that the founders in those cities living with their parents, having a steady income coming from some business. So they don't have that much hunger into the system, right? So they will start something, but they may not be so serious because everything is sorted for them in life in terms of, in case they're earning 30,000-40,000, they're fine. But then a lot of guys you will see that who come out of from that system and they see their father running a successful business. Now those things get into their genes, which means they could be a lot more successful in other businesses because they have seen how the process works for over, let's say, last about 8-10 years. So there the chances of success for such founders tend to even grow. But then because the ecosystem thought process is a lot more different, there people think a lot about business, while in the hubs, people talk a lot about startups. So marrying those two becomes a lot difficult in terms of mindset.
Right. And one of the things which we have discussed in our recent conversation is about founders' mindset to create money or give money back to the investors, right? This is for investment when you have made it like 5, 6, 7 years back. So talk about that. Like, what does that mean? Because what I see, especially on the D2C side, right, there is this perpetual need to raise money and then acquire new customers and then grow and look for adjacent opportunities, while there is very little thinking done. Okay, how can I give exit to my very early investors or my seed investors, right?
Right. So this is one thing which we are currently struggling with ourselves.
Right.
Because what you need to understand is that the guys who have already gotten funding, right now, they're blocking the funds in the system by keeping them unnecessarily in the system. So you do have early stage investors. Once they start getting the exits, they will start pumping that money back into new startups.
Right.
But in case the old startups continue to hold on that money, the problem is the angel investors who are seasoned, who have been in the system for long. Now their money is stuck, so they would not be investing in newer startups. So this money is like a flow. You need to let it flow. But what we struggle with is a lot of founders in their mind giving exits to the investors, early stage investors, is not even there. They would be continuing to raise Series A, Series B, Series C. Series A, they are raising $5 million, for example, right? The strategy could be they could raise $7 million and $2 million could be for secondary. But what I've seen is most of the founders tend to just raise 5 and stop at it. Now, obviously, let's say 80% of the founders somehow struggle to raise even 5. But the founders who can raise further, they don't actually start doing the cap table cleanup. And because of this, since the money is getting blocked, then people are not investing, and the new founders who are coming in the system, they're not seeing those kind of money coming back to them because the pool of investors is limited.
Right.
So what you will see is that once these IPOs hit, right? So once in the previous years, you saw Policy Bazaar, Paytm, everyone doing the IPO. That's the point there was a high in terms of investments, just because people got their money back. Now they started rotating that money. Now, with few IPOs lined up, chances are that there would be a lot more money getting into the startup ecosystem again. But this needs to be a constant flow at Series A, Series B, Series C. Because as a founder, you came to someone and said that I'll make 5x in 5 years or 10x in 5 years, right? Now, in 5 years, in case you can make only 2x, at least give that 2x back so that the money can rotate. Because what's happening is the angels generally, there are few angels who are late stage as well, but a lot of angels can play up to Series A, Series B, right?
Right.
So in case you're dragging them to Series F, then you are actually not making the journey joyful for them, and they will then stop investing in the startups, and they will turn towards the public market because it's much more liquid.
Right. And what do you think? Is this because mostly with founder mindset, or do you think on the investor side, let's say large VC funds, they are open to funding, doing those rounds where they're giving exit to, let's say, angels?
So there are a lot of other players compared to VCs, because VCs have got certain restrictions sometimes where they don't want to get into secondary shares, right? But then there are a lot of HNIs, family offices who are putting in, let's say, $2 to $5 million, and large chunk could be done in secondaries. And then there are funds who do specifically secondaries as well, right? So that can be actually sorted, because again, founders are not raising so much money that the secondaries can't be done per se. It's a lot about the mindset that I'm building the business, I'm taking money in, right? But for me, returning that money is not a priority, right? And one thing what we have seen is the companies in our portfolio have started paying dividends, or the companies where the shares are liquid, where they have done a couple of rounds of secondaries, raising further capital becomes a lot more easier. Because now people believe that the money will come back and serious money starts getting in there.
Right. So the amount of dividend doesn't matter. It could be small.
Yeah.
Right.
It just shows the intent.
Right. So I mean, in the startup subculture, let's call it, because it's part of the culture now. It's everywhere, right? Shark Tank, everybody's watching, and everybody knows about startups and funding and VCs. How do we build awareness around this? That when you are taking money, first you need to have that responsibility that I need to pay that money back, and also how do I put premium on the equity, right? Because a lot of time founders, when they're building, they don't seem to value the equity that much.
Right. So these are cases where I met few founders who came to raise equity, and their business was cash flow positive, right? So
Right.
the idea was, why don't you pick up debt from the banks?
Hmm.
And they said banks are charging 10%. We don't want to pay that.
Hmm.
That's why we are raising equity now.
Hmm.
That's a contorted view of the
Right.
equity system, right? Just because equity SHAs have been lax, chances are people feel that equity is a money which will just lie in my company till perpetuity, till the time I exit, right? So what we have started seeing recently is that lot many contracts are getting changed where there are royalty deals coming in, where there are profit share deal coming in, or there are, let's say, clauses where after 5 years or 7 years, in case company has cash, there needs to be a necessarily buyback. Right.
Hmm.
So now what investors have started seeing is that probably 7, 8 years back when we entered the system, what we felt is that the exit will happen naturally. But since that natural flow is not happening, now investors have started putting a lot of these conditions. Now, once you look at Shark Tank 1 versus 2, right, there were a lot of royalty deals which came in just because of the same factor that investors need to start seeing their money back, right? In case I invest in a D2C startup, now D2C startup scaled from 2 crores to 20 crores in 5 years, right? The founders are taking a bit of salary and everything, right? But I'm not seeing my money back.
Hmm.
So that's the point. All these royalty deals, rev share deals, or a buyback actually tends to come in. So the structuring of the deals is going to change somewhat in the ecosystem now.
Right. Right. And let's go back to the execution bit, right? What are some of the common mistakes which you see founders make, especially after, let's say, at seed stage or even before seed stage,
Right.
from execution point of view?
Right. The biggest mistake which we feel is that a lot of guys are building tech,
Mhm.
and in their mind, the customers will come and die for their product. That I just want to buy this. So they are in so much love with their product that they build the product, not thinking about how do I bring the client in. When we look at even the large players like HLL, Britannia, whoever it is, right? Everyone is doing so much marketing, so much sales just to get the customers in. You are a no brand as such, right? In case you're selling 30, 50, 100 crores revenue, you're not even a brand, right? People talk about a 10 lakhs monthly sale as I'm building a brand. Now that's something like a misnomer for me. But still, like the whole idea is that once you get into the selling piece, right, you need to know exactly how are you going to reach the customer. And the cost of reaching the customer should be less than whatever your gross margins or your net margin is, just so that you can cover your cost. There is no fun in selling something for 100 rupees when the cost of reaching the customer is 80 rupees or 120 rupees.
Right.
So that is one big problem what we see in the system, is that people feel customers will come in. Secondly, a lot of founders are afraid of reaching out to large companies for selling in the B2B side, because they haven't have the experience of talking to the large players. So the second problem which we see in the system is that on the B2B side of the sales, people, the founders are the guys who need to sell their product initially to see if it works. But they tend to hire the sales team early on, hoping that someone else will be able to sell their product. Now, in case you're the founders, you don't have the right skill set to sell, then it's a difficult journey for you to build out a product which sells. Thirdly, what I've seen is a lot of time people start businesses with their friends and family, right? Where the skill sets are homogeneous, right? So everyone is a CA, everyone is coming from the same engineering batch. So everyone is a techie, but they don't have a CFO or a sales guy. So your team composition needs to be stronger and diversified. Finally, let's say on the other side, the thing is that a lot of times we continue to beat upon something which is already dead. So in case your product is not working, clients are not willing to pay for it, then you need to either enhance the feature or change the product altogether.
So the way I'm understanding is probably distribution, sales, people, and pivoting.
Sure.
These are the four areas which you think are important.
Right.
When it comes to sales, right, it's not an easy thing to
Right.
do. and not everybody enjoys it because
Right.
it involves rejection,
Right.
right? It's psychologically, it may not be the best experience you may have, right?
Right.
Because all of us think that we are great at X
Mm.
while we get rejected for X when we try
Right.
to convince people, right?
Right.
So about sales, how do, especially in B2B, right? Because that's where you have a lot of experience. How should people go about it, or how should they, if they're building a SaaS company, for example, or anything which is a layer,
Mhm.
right, on top of existing businesses,
Sure.
how should they plan for it? In case the founder, let's say, already knows that I'm not good at sales,
Sure.
right?
So you need to have a co-founder who understands sales, right? This is one thing which we look at a lot of these B2B companies. So for us, even a product we can compromise, not on sales, right? So you need to have enterprise sales guys who can come in and start selling for you. So either you need to have a co-founder, which is the best thing, and in case you don't have that one, then probably don't start the startup.
Right.
That's the second thing. In case you're struggling, there are a lot of channel partners who tend to sell for you.
Right.
But then it's more like you're going to Amazon and asking Amazon to sell for you, right? Now, either your product is so amazing that it'll sell, otherwise, channel partners can just boost your sale a bit, open up new geographies. But in case you're not being able to sell in your base geography, then chances of a channel partner selling your product is low.
Hmm.
So you can't say that I don't enjoy driving, but I want to win Formula One,
Hmm.
right? So there are basic skill sets required for certain companies. Try not to start something in that zone unless you are comfortable about it.
Right. And about pivoting, right? When do you know that it's time to change direction?
Right. It's a tough question,
Yeah.
right? The thing is that you tend to work towards a goal, right? And
Right.
you don't meet your target. You know that there is something wrong and you need to change something.
Hmm.
You do that adjustment and run the process again. Now, in case you again get a negative result or not so positive result, you pivot or you fine tune for the second time. Now, for me, 3 times is, I think, good enough. Now, in case you're not being able to, let's say, grow after 3 iterations, then it's time to pivot because either the product is not fit for the market or you as a founder is not fit to run that particular product. Now, there are cases where people have done it in 7, 10, or 15 iterations. Always the cases, right? But why do you want to take a hard road?
Hmm.
Right? You want
Right.
to build a business, so build a business which is a lot easier or in your comfort zone then.
Do you have those conversations with founders after you're back then?
Yeah, these kind of conversations tend to happen quite often about the kind of product or the services mix they need to have. Even sometimes, let's say, changing the teams and all that. Because
Right.
once you're working, you get emotionally invested into the company. And though you know the answer, you generally don't want to execute. And
Hmm.
that's the point you want to have investor or your mentors as a sounding board to be able to work it on. And a lot of time people haven't seen the experience because what happens is in case you haven't experienced failure in the past, you just continue to hope that things will work out one day. But then once you see people who have seen failure a lot, they know when to stop,
Hmm.
right? So that's the place where you need to start looking at investors, mentors, or even your family for support and running your ideas again and again.
But as a founder, do you think it's easy to reach out for help outside your investor base?
It's actually the ecosystem is there, right? Now, in case you feel shy about reaching out, then that's a personality trait which should not be there in the founders. It takes time to come out of that hitch because a lot of time we feel awkward reaching out to people, right? But that's something a skill set you need to learn. In case you're not being able to learn, just do a training on that,
Right.
right? Because a lot of time once we previously talked about enterprise sales, right?
Right.
Now, one of the things is in case you're not confident, you start doing the enterprise sales training, you start doing trainings on negotiations and all that, right? In case you don't know how to drive and you want to still
Right.
go for Formula One, then you start learning about it, right? What you can't say is, I don't know about it, I don't even have time to learn. Then you are wasting your time.
Right. So you need to start walking towards your destination.
Yeah.
Even if you're walking at a slow pace.
Yeah.
So it's also growth mindset, learning
Right.
new things, right?
Right.
Which I think is important as a founder, right? Because every situation is going to be different.
Yeah.
Even every sales conversation will test you in
Sure.
terms of what you can bring to the table, especially when you don't have credentials in the beginning, right?
Right.
Because people will ask you tough questions,
Yeah.
right?
Right.
So the idea is to not take that personally, and then also seek mentorship, right?
Sure.
Um, Also between product and sales, right? A lot of founders, you said, they are in love with the product. They spend a lot of time on the tech side thinking about ideation, but the commercialization bit is lacking.
Yeah.
Right. Often we see that the average product with the right commercialization can see success,
Right.
while a good product with poor commercialization can still be a failure.
Right.
When you are meeting founders, a lot of time probably you are meeting at idea stage when you have not seen not the product or the commercialization bit, right? Now at that point, how do you take that back?
A lot of it is background, right? So what you have done in the past, in case it aligns with what you are trying to sell, that's one thing, right? Secondly, in the sales, you need to present your idea. So when you are presenting your company to us for investments, your sales skills start showing.
Right.
So that is the second check which tends to happen. And a lot of time, let's say we don't meet very early stage founders. Once you've got 5-6 months run of your startup, right? That's the point how your GTM strategy has been built, right? Is it something I'll just do Facebook marketing, or you have thought about it that this is the kind of ROAS I'll get, these are the channels I will go to, and this is the amount of time I'll invest. So you understand the space or not, right? So once you get to those kind of details, chances are that you will probably make a decent bet. But again, a lot of time you can't even judge a lot of these things.
Right. So it's like I think it's like a box of chocolates. You don't know which one you're gonna get.
No,
I think if you take out the background bit, right? Let's say
you're taking out everything.
I'm just trying to think how to phrase this.
No, so one of the things which I want to probably differentiate, this is not a box of chocolate where you need to test out 200 chocolates, right? The thing is, in case you are coming to sell me your project or your company, right? Now, in case you don't give me the confidence that you have the skill set to sell, I'm not going to invest, because out of those 200 chocolates, I need to just eat one. Right. So there would be 5 guys who would be able to at least sell me how they can sell their product. Right. So what I'm not doing is I'm not judging each of the companies on their merit. My job is a lot easier because I need to just select the best one among 200.
Right.
So it's not my job to bring out your strong points. It's your job to bring out the strong points to me. Because in case you can't sell your company to me at this stage, chances are you may not be able to sell your product. That's a very generalized statement. But that's like a kind of a thumb rule which we tend to follow. Right. And makes our life easier.
So beyond, initial traction, a lot of energy and difficulty comes in when you think about scaling, right? Now, scaling, as we discussed, is a totally different animal, requires totally different mindset. And there are many ways to scale, right? It depends on the business and the segment you are playing in, right? When it comes to scaling, we discussed about mistakes which founders make at idea stage. But beyond commercialization, when we talk about scaling, what are some of the mistakes which founders make at scaling stage?
So normally, I think we can probably break it down into a B2B and a B2C sales, for example, right? A B2C product, chances are that you tend to stick to the strategies which worked for you from 0 to 1. Right? In case you're able to sell on Amazon, right? You can sell probably 1 crore, 5 crores, 20 crores, but then you will plateau out. Right. In case you continue to run the same strategies from 0 to 1 to 1 to 1000, that's not going to really work out there. So you need to change your channel mix, for example. Then you need to bring in the kind of guys who understand different channels of sales. So that becomes the key once you are running a B2C site, right?
Right.
But the founders tend to just work on the bit which was working from 0 to 1. On B2B side, it becomes really easy for us to see, evaluate. Now, one of the problems which we feel again founders is that they start hunting the elephants from day zero. Elephants are your large clients, right?
Right.
So till the time you have built your credentials, it's very difficult to sell to a large organization. So you need to build your bridges in terms of showing your credential, sell it to smaller guys, then to the mid-sized guys, and get to the larger guys. The larger guys will take 9 months to buy, while the smaller ones will take probably a month or probably 15 days to buy. So till the time you don't follow that structured sale process, which runs in large companies, which is freely available, but in case you don't run it even in a small company, chances of growth becomes, let's say, hampered. So these are the kind of mistakes which we see during the scale up, that you tend to apply the strategies of the 0 to 1 and 1 to 100.
Right. And that's also the point where you need to bring in experienced folks into your team and be able to manage them and take them into confidence as part of your journey. Right.
Yeah.
A lot of young founders may not have that experience because they have not worked with people, and then a lot of them take difference in opinion as challenge to their authority or things like that. Right. So how should founders think about this journey? Right, because you're bringing in, let's say, somebody who's 25 years of experience into B2B as part of your, let's say, VP of or president of X or VP of X, then how does that work out?
Right. So one thing is, I think this is a problem because of media hype as well. A lot of founders tend to feel that they are solving a problem because larger guys have not been able to solve that problem. The problem is that Reliance is not doing something, what you are doing, because it's not worth Reliance's time to do that. So once you bring in a senior guy from a large organization into your fold, a lot of time founders still feel that they know everything. They themselves, right? Now, once you're bringing in the experienced guy who have scaled from probably 1 to 10, you need to start listening to their experience. You can discount to some level. But in case you've chosen your advisors well, they are showing you the path, how you reach from 1 to 10, plus what are the kind of mistakes they have done in the past. So you can't just discount those things upfront, telling that I am fast, these guys were slow. Then you don't really do those kind of guys, right? So what you really need is to get the right guys, and you need to have the temperament to listen to them as well. Because that's the experience talking.
Right. And I think a lot of it comes again to interpersonal skills. How do you build rapport? Are you comfortable, not comfortable working with them in long term? And once you have good rapport, I think it becomes easier.
Yes, right.
I think one of the reason which has taken this startup ecosystem on a different trajectory is the whole hype around funding.
Right.
Funding, fundraising, people are looking for investors, right? So when you think about founders, right, even before they have their pitch deck, they're thinking about fundraising, about valuation, already meeting investors, right? How do you think about that?
So that's probably the negative side of the ecosystem which we are playing in. A matrix which should not even be a matrix is being hyped about. And I think the problem is that that's the only metrics which is freely available. Whatever people have raised as what is talked about, because going down to their financials, talking about, let's say they made so and so profit, that's one not very jazzy. Plus, that's difficult work to dig out that information.
Right.
So whatever is available in the market, people tend to talk about that more. Now, that has actually, in my mind, just distorted the way the startups should be done. And that has increased the failure rate. Because when I think about opening up a US office for my company, I would feel that I just need $100,000 to open up my US entity, because building out a US entity will cost you potentially about $4,000-5,000.
Right.
Plus, you hire a sales guy because the product is being done in India. In case the sales guy doesn't work for 5-6 months, then obviously you're going to fire. Now, a base salary for a US guy needs to be about 100, 150K, not beyond that. Rest everything needs to be commissions, right? Now, once I look at founders coming to me, I need $1 million because I want to start US office. While in India, their revenues are hardly about $1 million, right? That's the place we see the disconnect happening between the business and the funding. And then people start feeling that other company got the same amount of funding with less revenue. I should be entitled to get that kind of funding. That just distorts the whole perspective from building a business to getting funding. Now, getting funding is you are taking liability, while building a business is you are creating an asset. Right. So somehow I think because of all the probably the noise in the system, the basics have actually been changed for certain startups. Now, there are certain places where funding is important, where you're doing something in deep tech, where you're doing something in the space field and all that stuff. So there, a lot of these things become relevant, but not in a basic kind of a startup which is doing what other guys are already doing.
Right. And I think a lot of it has to do with, let's say, not having understood the cost of capital. Right. So one of the important concepts or subjects which people tend to, undervalue is accounting.
Yeah.
Right. Accounting is the language of business, and people need to understand that investors' money is not free. Right. So I think that's also something which founders should try to understand more.
Right.
And as they grow further, I think this becomes very critical, right? Understanding accounting, understanding SHA, and what kind of agreements are you signing.
Right. So one of the red flags for us is when we talk about valuation with a founder, and founder says my CA did it, and this is my valuation, we are anyway going to decline. We don't go beyond that.
Right.
Because as a founder, you need to understand what you're asking for, why you're asking for, and what you would be doing with that money to grow. So that's the basics.
Right. And how do you value a startup, right? That's another thing, because generally we are talking about either we are thinking, okay, cash flows, we don't know, right? And so people are using, some rule of thumbs, maybe applying some multiples, looking at some comparables.
Right.
But what is the best view? Because you have so many, entry and exit points at so many early stage companies. How should we think about valuation?
Right. So it becomes a lot easier once the founders have done 4-5 crores revenue, because then there are thumb rules in each of the industries that in case you're a SaaS founder, you will get 5 to 7x of your revenue, for example. Currently, D2C founders can get about 2 to 3x, for example. So the models are set once you start growing.
Right.
Now, once you're at an early stage, right, for the investors, that's the point you need to look at the management quality, and then you need to look at the growth potentials, and a lot of those subjective things come into mind, and that's what makes it a lot riskier, because now you're taking a bet not on the market, not on anything, but your ability to predict the future of this startup, that the founder will work out, the markets will work out in the favor, execution will be fine, and that's why you are taking a bet. So at early stage, more data points you get about the founders and the business, it becomes slightly easier to value a startup. But normally, let's say what you see is that what's the 5-year outlook of the company, right? So 5 years down the line, if the company is saying they will do 100 crores in revenue with a 10 crores PAT, right? Look at the market multiples. That's the valuation the company will get in the market in case they list after 5 years. Right? That's your base. Now, whatever is your IRR, you want to make 10x money in 5 years, you just discount it back to by a factor of 10. So that's the max value you can give to a founder at this stage. Right? And then even at the early stage, the idea stage, there are certain thumb rules which people have now started setting, that in case you're a pre-product, I'll give you $1 million. In case your product is done, I'll give you probably $2 million. So those kind of thumb rules you need to work with.
Right.
Yeah.
What about angel investors? How should they think about valuation? Right. Especially, let's say if you are giving a sizable check, let's say 1 CR or more, or even 50 lakhs, right? Now that's a lot of money for an angel investor, because that he may be allocating a part of his savings, right, to early stage ecosystem. In case they are not doing it through an angel network or through a syndicate, if they are doing, let's say, direct capital investment, then how should they think about? Because in that case, probably at idea stage, they are the one who are anchoring the whole thing, right?
Right. So in case you want to become an anchor, right, you need to understand the company inside out. Else you're not an anchor to that company, you're just throwing in money, right?
Right.
So generally anchors come in the industry in which they have a understanding or they know the founders from before, right? In case it's Kulmani, for example, right? I am fine putting in money because I've seen him for 15 years.
Right.
He will do something, right? So and hence I'm fine putting in money, right? Otherwise you understand the industry well because you are working in the same industry or you have seen the same gaps as what founder has seen, and potentially you might be able to help founder navigate certain things. So a lot of these subjective factors start becoming a lot more important in early stage investing, and that's why it becomes a lot more gamble at that stage. Because you are looking at 5 factors, but then you are discounting 10 other factors which you should have looked at. How the compliance will be happening, whether the founders has got staying power. If the company doesn't work out for 2 years, would the founder bail out? Right? A lot of those factors you just tend to discount, and that makes the whole proposition very risky for you. And that's why you should not be putting your safe money into startups at early stage. Because that's not the place it should go.
Right. I think when you talk about comparables, right, especially if there are startups which are at the intersection, probably a new emerging area or a theme, or let's say something like AI, or even let's say health tech or fintech. Let's say talk about like last decade before PTM, right? There was no precedent, right? There was nothing you could compare it to because UPI still, we didn't know about the potential. We didn't know how many transactions are we going to see, and the adoption we were not clear about, right? And if you could see that at that point, you probably made a lot of money because you probably took bets in fintech, whether in the payment space or other sectors within fintech, right? So how do you balance that, right? So one is the rule of thumb where you're comparing it to existing or something which you have seen, or let's say in your comfort zone where you are operating and you are becoming an anchor, right? But if you're thinking about forward looking, venture seems to be forward looking than backward looking. Well, any investing is forward looking, but still in public markets there is a track record you can compare to, right? So how do you do that? How do you do forward looking investing as an angel?
Yeah, so that's a place. There is a sophisticated investor and there is just an angel investor, right? A sophistication comes from your experience, right? So the idea is that there are probably 150,000 startups in India, right? Now, why do you want to go outside your comfort zone? And for example, I don't know anything about pharma market, right? Why do I want to go and take a bet in pharma market when there are 10,000 startups in the fintech market, which I understand well, right? So that diversification into pharma market needs to happen a lot later in your journey compared to doing early on, because then you have got, once you've seen, let's say 10,000 startups like us, right? Then you start bucketing those startups into let's say certain classes, and then you are able to value them slightly more scientifically, right? But in case you don't have a data early on, don't venture into the areas which you don't understand so well, because then you're not taking a calculated risk or bet, right? So the whole point is, in case you want to gamble, you can gamble anywhere, right? But in case you want to invest, then you need to do your analysis on the companies before getting in. Right. So a lot of time people are getting pulled by the fact that someone made 500x in Swiggy or somewhere else, right? Now, in case you want to gamble that thing, go to probably Atlantic City, right? In case you put in money on number one, it comes in, you will make 36x, right? But that's not what you're doing while you're investing, right? In case you're gambling with Swiggy, do that. But in case you're investing, then you need to do your analysis, only then get in. Right. So that's why what we say is that once you are a sophisticated investor, the risk goes down significantly just because you understand the risk and you're doing your analysis. In case you're getting without analysis, then you're gambling, you lose money, then don't cry for me.
Right. So what I'm also hearing is that if you're doing large checks as an angel, you need to be an active investor.
Yeah.
Right. So you actively needs to seek new themes, learn about the market,
Uh,
and also be involved after you have deployed money.
exactly.
Unless you have the bandwidth to do that, you should not write large checks.
Large checks is again compared to a wealth, right? In case you
Compared
do
to
have
right, right,
thousand crores
exactly,
lying around, a crore doesn't mean much, right?
right,
So you just put in money.
right,
But in case your salary is only, let's say, I don't know, 50 lakhs or 1 crore, whatever SEBI prescribes, let's say it's only 1 crore, right? Then putting in 5-10 lakhs check is large. It means something to you. Then you do the analysis or write on someone else's analysis. Don't go in blind into the pool.
right. So you're saying go with syndicates or networks which have good reputation, have the track record, and invest through them in smaller checks.
Right. Either syndicates or even your friends, right? So in case I want to analyze a pharma company, one of my friends works in pharma, I would at least have advice from him whether this product even has got legs or not. Right? So even if you want to go solo, no problem out there. Yes, syndicates are a lot safer because there is a lot of analysis which is already being done. But even if you want to play on your own, just play with the right set of guys. Don't play alone in the field which you don't know anything about.
Right, right. And as a founder, right, let's say I have early traction. I'm thinking about growth. And at what point should I think about fundraising? So we have agreed that fundraising is not necessarily bad, right? Some cases you do need some capital. Let's say you're building some deep tech product or you're expanding into a new market. So your current operations are, let's say, beta positive, but to set up a new office, you need certain capital and money or to hire new team members, right? So at what point should founders think about fundraising?
Whenever you feel that you have reached a stage where putting in more capital into the business could help you with the growth, that's the point I think you need to start raising money. Now, early stage funding could happen in 3 to 6 months, while late stage funding can take, in the current scenario, as good as about 6 to 12 months, right? So you need to think forward and start preparing your round before that. You may not trigger the investment till the time you're ready, but you can start baking in the deals before that. So normally, at least have a 3 to 6 months runway before you start thinking about fundraise. But fundraise needs to come in only when you feel that money can solve your problem. Right? In case you have a product and you're not being able to sell, then whatever money you throw in it is waste.
Right. Because that's also a common theme, right? When I meet founders, they feel like the response is that I can't do this because I don't have money. And most of these things may not have anything to do with money. For example, you could generate leads through LinkedIn, you could generate leads through your employer connects, you could generate leads through different avenues, right? So I think that's also a misconception there.
That is the reason why we say that, I don't know, 90% of the startups fail. The problem is the founders who are starting, and I'm not saying in all the 100% cases, but in a lot of cases, founders don't have the required skill set to run a startup. And required skill set, one is you need to have the product side, and secondly, you need to have the sales side. Right? So till the time you do have that balance out, it's very difficult to run any kind of business.
We were discussing about founders mode and how they need to be horizontal in terms of their skill set. So there is a website run by Paul Graham, who is the founder of Y Combinator, called paulgraham.com. It's just a basic website where he publishes different essays, right? So you can go back into, let's say, the early days of Y Combinator, how many partners and how to build that, right? So there is a recent essay which came a few months ago. It's called the Founders Mode, right? Which is exactly summarizing the theme which we are discussing. So it's based on a talk which was given by another partner at YC event, a founder mixer, which summarizes, the essay summarizes that talk basically, right? So it talks about something called the Founders Mode. So Founders Mode is very antithesis of modular approach of building teams. So let's say you have a president of sales who is managing sales and marketing department. So he says that founders need to be actually horizontal and be involved at micro level, right? And they can't build teams the way corporates are built, because that will not set them up for success, right? Because you are trying to break a pattern, right? So, and you can't break a pattern by building the team exactly the way Reliance is building or Tata is building, right? So I think that essay is very important, and I think just like 10 minutes read, but it
Right.
summarizes everything very nicely, like how you should think about
Mhm.
building early stage, especially when you're talking about, let's say, first 10 team members, right? All of them need to be very horizontal and be able to do everything, right?
Right.
There is no like guy, okay, only two people are going to face the clients or
Sure.
the sales, right? So that's the similar thing, right? Um, so we talked about fundraising. They have traction, they need money for a variety of reasons. When they go meet investors, right? What are the traits founders should look for when they are meeting investors?
So this is like, again, you are selling a part of your company, right? And your company technically at that level is your professional life. So what you need to see is how well do you gel with the investor? Is the thought process aligned, right? A lot of time you are so desperate for money that you don't really look at a lot of these factors, which is, I think, fine in case you are desperate. But in case you've got luxury of time and luxury of choice,
Right.
that's the point you need to see whether your thought process is aligned with that person. So one thing is that it's like, it's not just a transaction where you are taking money from the investor. In case it's transactional, it's fine. You take anyone on the cap table till the time their money is clean. Otherwise, in case you want to interact with that person over a period of time,
Right.
there's a lot of things which you can learn mutually from each other, the founder investor, right? So then you want to get people around you who will be able to support you in that journey.
Hmm.
So those softer aspects plus the skill sets, those are the kind of things you may want to look at investor. Now people don't do their homework. Now in case you're coming to us, just look at our portfolio companies. In case you're going to a VC, look at what kind of companies they have supported. Are there synergies? In case you have time, talk to the founders of those companies as well, how the investors are, right? Do they meddle with your day-to-day operations? That becomes a lot relevant at the higher stage when you are raising serious money. At early stage, normally just look at the way we do a diligence on the company. You may want to do similar kind of diligence on your investors as well.
Right. So what kind of traits will you look for when you
Someone
meet them, let's say, for the first time?
So normally you look at one in terms of again their behavior. It should not be aggressive, arrogant, and all that, because that's the problem you will face going forward.
Right.
Till the time, again, I'm saying you're not looking for just money. In case you're just looking for money, then it's fine. Secondly, you need to look at patience in the investors.
Right.
Because you are building a large, let's say, organization which will normally take you 7 to 15 years. That's our horizon for investments, right? In case you are planning to exit in 3 years' time, there are hardly companies which are able to exit in 3 years' time,
Yeah.
right? So you need to see the person can actually stay with you for slightly longer period. Thirdly, when you look at it, does this kind of money changes the life of the investor? In case it does, maybe that's not the right investor for you, because then the person will continuously ask you for updates and things like that. So these are probably a couple of things which you might want to look at in the investors per se. Skill sets, their connections, look at their LinkedIn profiles, how well connected are they, can you leverage that? Those are again certain transactional things you can still look at.
So what I'm also hearing is that it's a duration game on both sides.
Yeah.
Right. So on founder side as well as on the investor side.
Right.
Because it's a 7 to 10, 15 years journey.
Right.
So you need to think of that duration.
Right.
And I think the reason when you mentioned that a lot of your failures have happened with young founders is because they're not able to think in that time horizon. I think this is my hypothesis.
Right.
Because let's say somebody like me who worked for, let's say, 15 years before getting into startup world, I could already see my career in phases. Okay, 5 years I did this, and this is the new skill set which I developed, which helped me go to Y, and from Y I went to Z. So you are able to think in those sort of time lapses and do some planning for forward, looking ahead also.
Sure.
Right. So I think that is a skill probably who, founders who are 30 plus will find it easy to think in those phases.
Right.
Right.
So this is one thing that a lot of the corporate systems, they are your training grounds, right? I can talk about a lot of these things because I spent 15 years in corporates, right? So there you are working in a lot more safe environment. There are processes in place which are able to help you scale up,
Right.
right? And no one is actually forcing you to do lot faster, because you're spacing your growth according to your skill sets, because that's what a lot of companies have started looking at. So once you come from that environment, right, you see what it takes from moving from 0 to 1, 1 to 10, 10 to 100 in a very structured way where there are people to handhold you.
Right.
Now, with the problem with the founders is that because they are the ultimate bosses out there. So unless they have built their support system in terms of mentors or in terms of coaches, in terms of seasoned investors who are guiding them, they don't have luxury of that kind of learning which is coming in. And that's the point you hit a wall, you feel that now everything is going to collapse. And that's the point you tend to quit a lot easier.
In my consulting days, I do remember around 2015 being in a room with this CEO, and we were working on 2030. So 30 pointers for 2030.
Oh, wow.
So 15 years in advance. So it's a large company, listed company. But that's the kind of planning which I saw people, thinking about the next frontier, next wave. Another example which I recently read about is Bajaj Finance. All of us get those spam calls, right,
Sure.
from Bajaj Finance. But they have something what they call the long range planning. So they go on 2-day hike with the top leadership team, and that's where they sort of brainstorm and decide, okay, what is the next summit for us as a team. So I think they do it every few years. I think annually they do it, where they review last year's goals and discuss about the next summit and next thing. So I think on the corporate side, it's already well built out. So they have coaches and internal teams which help them, and even consulting firms are helping them. Right? Bain, BCG, McKinsey, they're helping them. But I think on the startup side, the reason why founders may find it chaotic because they are so caught up with operational things, right? So they are not able to zoom out and think about it, right? Okay, like what is my 3-year goal, or what is my 5-year goal? And especially if you're in tech, right? Things are changing all the time. You're updating, you're revising your tech, you're thinking about your tech stack all the time. So at what point do you think it's important for founders to, let's say, plug out a little bit, maybe every 3 months, every 6 months? How do you think they should plan, especially in, let's say, when the traction is not that much? Maybe you are doing, let's say, few lakhs per month, right? So you are barely surviving or scraping through. You have not raised any seed money or anything, but you still need to plan. So how should they think about plugging out at that point?
See, it becomes a lot more important for the founders who have not been able to do good, right? Who are just scraping through, surviving, because this is not something you want to continue for next 5 years. And whatever skill sets you had till date, you have used them, and you have reached this stage. So in case you want to change something in your life, you need to plug out at that point of time for a week. A week doesn't change a lot of things in that startup, which is like, again, just scraping by. Right? And that's the point you need to start learning new skill sets. For example, in case your sales is not happening and you're a B2C or a B2B guy, depending upon what kind of courses you need to get into, do that. In case you need to meet a lot of seasoned guys from the industry, do that. Because that's the kind of learning you need to continue to do. Otherwise, you're becoming outdated even in a startup phase.
Right. Often, right, we talked about investor founder conflicts, right? But you may also have, let's say, conflict about the strategic direction of the company.
Right.
Let's say, as a founder, you may be inclined, or you may be recommended, let's say, in terms of tech, let's go with X, and the founder may be inclined to go with Y, right? So how do you navigate those conversations with founders?
So normally, it's a difficult one depending upon what kind of investors or founders are there. Generally, in case it's a uh, strong founder with good numbers, good execution, chances are most of the investors would tend to listen to them. The conflicts become more probably prominent when the company is not doing good.
Right.
That means something which the founder has been doing wasn't working. Now the investors try to desperately try to turn it around. Now there are good suggestions coming in, bad suggestions coming in. But yeah, that's the point. Sometimes it starts getting messy. So normally it's more about once you get into that mess, it's very difficult to navigate. Only point is that you can try to showcase your point again and again to the investor that this is the way things will potentially turn around. In case it will take you 1 year, do a small POC and showcase that there would be results coming out. In case what investor is saying again makes sense or doesn't make sense to you, maybe do it for 7 to 15 days and see what are the kind of results which are coming in, because you are anyway not doing so well on the startup side. So depending upon the situation, there are multiple ways of navigating it. So there won't be a solution where we can talk about this is the way you can do things. But again, the fact remains, in case you have been openly communicating with each other, chances of you reaching that stage are low.
Right, right. And how do investors take if their, let's say, recommendation is disregarded? Obviously, that depends on the experience, but generally, do you think that affects the relationship with the founder?
Yeah, it depends upon, let's say, how much stake the investor has.
Right,
Now, in case we are getting in, we don't really worry about how the founders are running the company, because that's the way, like, we invested on the founders, right? If they're making mistakes, if they are doing something wrong, that's what we signed up for.
right,
But once you get to the late stage, you have put in, let's say, 50 million, 100 million of the company. That's the point. There's a fiduciary responsibility, though their fiduciary responsibility is at the early stage as well, but at a late stage it becomes more prominent. So there they need to actually see how the founders are performing. So whether they need to coach them, mentor them, or probably get involved into the operations in case things are not going right. So there the intrusion, what founders call, would be a lot higher. Early stage investors generally just tend to give suggestions, not get involved into a lot of ops.
right. Let's say you have invested in a founder, he
Hmm.
randomly calls you that we are making this pivot
Hmm.
in a totally like a 90-degree or 180-degree
Right.
trajectory from that, right? So how do you take that call?
See, the problem at that stage is we are already invested.
Right.
Right now, founders can't give back our money.
Yeah.
Right. So you are stuck. At that point of time, the best strategy or best thing what we can do is that we can just tell them the pros and cons of running that particular pivot, because that's the place you would see whether it's working out well or not in terms of your personal experience.
Right.
And in case you feel very empty that pivot, right, we can just express our views and say that this is because of so and so reasons you should not be doing it. But finally, it's the founder's call if they want to listen it to or not.
Right, right. Has there been an instant where you had to cut ties with a portfolio company in a difficult situation or after a difficult conversation or something unethical happened at the business?
That is like not rare.
Right. It's
So
not rare.
it happens like once you run a large portfolio, we do have now 102 companies in our
Right.
portfolio. So this kind of a thing will come in about 20 to 30% of your startups anyway, where you need to cut ties means like you just need to write it off kind, right? Because there is nothing else you can do. Otherwise, in case you can claw back some equity, you tend to do that. Then unethical practices, again, let's say because we worked in investment banking / private equity space, which I think at least the side we were in is ultra clean, right?
Right.
There are a lot of, let's say, compliances out there. There are a lot of regulations out there. So a lot of things which happen in the startup ecosystem, you tend to feel those are unethical, right? And that is something which we try to coach founders on. We tell
Right.
them that's not right. And there are places where we have even sued our founders because like there are certain ethical things which you can't play around with.
Right.
So compliance is something I think which needs to be taken very seriously.
Right. And at some point when you, let's say, find a problem, do you have a conversation with the founder first?
Yeah,
And
that's always the case, because the idea is we don't want to get to a legal thing upfront. Reason being that it's our good money which we will now pay to the lawyers, and from the founders' side they will fight back with the money which we have invested in them, right? So that's not a good outcome for both of the let's say for the investors or the founders. And whatever time we spend on probably fighting out with the founders not doing the sales.
Right.
Right. So it's always good to talk it out. A lot of time it's because of ignorance of the founder. A lot of these unethical practices crop up.
Right. Let's say you are a small angel investor, maybe early stage. You just started. Early stage meaning this is your first or second investment. Then how much should you plan to write off in long term? Let's say you are taking 20 bets over next 5 years or something like that.
So there are two kind of write-offs, right? One is where you already know that the company will die.
Right.
Second is in your mind the company is dead, but the company will continue for another 10 years. Right? So once you combine both of these, and when you say that the company will continue for 10 years, the problem is the company will run like a regular business.
Right.
With not enough cash flow to pay you back, with founders intent not to pay you back. So that's in a way a write-off for you. So in our mind, we have assumed that 60 to 70% of our portfolio would be in that category.
Okay, so the company will continue to run like a lifestyle business, but you will not get any return from that company.
Yeah.
Right. The company survives. Right? Yeah. While you have no communication with the founder actively.
Sometimes we do have communication with the founders, sometimes we don't.
Right. So it's a mix.
Yeah.
Right. When you talk about startup subculture, what themes do you think are overhyped? Could be trends, could be themes, either from the founder side or the investor sides.
Okay. So I think it's difficult to pinpoint because we are very probably, though we say we are sector agnostic, but we tend to put money into the sectors which we understand.
Right.
But for us, something like AI is currently, which we feel is overhyped, because 2002 when I joined job, right? That's the point a wave of AI was anywhere there. There was a lot of automation happening at a lot of places, and people's job would have been not there, right?
Right.
23 years down the line, we see the same jobs still existing. Right? So AI, I feel, is being overhyped at this stage. Secondly, I think on the EV side, there is, we feel, some bit of hype happening. Because it's just more about that EV are still running on electricity, which is producing like your pollution.
From the grid.
From pollution again into a different zone. So you're just shifting pollution from one place to other place, which is again a very good thing because you are moving pollution away from crowded cities to a place which can absorb that kind of pollution. But finally, EV is nothing, just a mode of transportation.
Right.
Right? Which is a cleaner, right? Now, a cleaner mode of transportation gives you that, okay, something which you were doing wrong, you're putting it right, but it doesn't change anything in the transportation ecosystem, which is the base. So there we feel that people are putting in a lot of EV into the system or into their pitches without any benefit out there.
Right. Even with transportation, right? Commercial vehicles still are not running on EV. Right. A large portion. The large, let's say, amount of pollution through transportation may be coming through commercial vehicles. Right. Cars may be contributing only, let's say, less than 20%. I don't know the exact number.
Sure.
But 80-20 may be applicable here. Sure. Right? So that's true. And when you think about screening, right? So how has your screening framework evolved even during these last 7-8 years, right? I mean, personal portfolio, obviously very different risk profile, but now since you have this discretionary pool of capital which you're managing, so you have more responsibility, right? Fiduciary and direct responsibility, right? So how has that evolved?
Right. So something like potentially a naive investor when we entered the market 8 years back, everything looked new, everything looked shiny. There was a lot of FOMO that there are tons of investors sitting in the market,
right,
who will pick up the opportunity in case you don't pick up. So a lot of those fears were there, and then we were again jazzed by a few of the media reports about two guys building a $1 billion company and things like that. So a lot of those things were noise in our system, and we to some extent probably moved away from the fundamentals of investing. which we learned in our investment banking or private equity days, right? So we started taking slightly reckless bet, which we currently feel that today, how can I even invest in that kind of a company? So over the years, now we have started looking more for execution versus a newer idea. We have started investing more into experienced founders compared to the freshers at this stage. So our portfolio has become a lot more stable, lot more like a disciplined portfolio compared to a high risk portfolio which we were running 8 years back. And one of the factors is that people, let's say, a lot of people understand, but a lot of new investors in the system, the thing happens is entry price becomes a key metrics for any kind of returns, right? So
Right.
when we were investing 8 years back, that point of time the industry was nascent, and there was a lot of alpha available in the market because the asset class was being run by only few guys.
Right.
But as the general public start coming, a lot more investors start coming, your returns starts contracting. So it has come down substantially over 8 years. We would have lost almost about 50% of our alpha by now, right? So as the asset class matures, you start taking a lot more defensive bet, and you are looking at a lot more probably not making losses compared to making a alpha out there. So that way, I think the portfolio has become a lot more defensive, lot more focused on slightly larger bets. Because one of the things now, once we look at any new company, is that company better than my other company which is raising funds?
Because you have view,
Huh.
you have the overall view, right?
Yeah.
Right. So that gives you an advantage.
Definitely.
But with this defensive, not defensive, but different strategy, what happens to your IRR?
So IRR should improve.
Okay, because you're taking the write-offs are much lower.
Yeah.
And then your bets are more concentrated.
Right. Then we have moved away from FOMO, right? So previously we were looking at 1 in 30 investments. Now we are cherry picking 1 in 200. So logically, okay, we may be leaving out a lot of winners on the table. But again, since our capital is limited, right? So once you do 1 in 30 versus 1 in 200, chances of you picking a better bet in 1 in 200 are slightly higher.
Right. I wanted to ask you about your general advice to founders who are either in their professional life thinking about starting up or somebody who is still at idea stage. How should they think and plan about their journey for next few years?
Right. So the basic advice I would again give, which was potentially the starting point of this podcast as well, that there is between a private and the public market, there is only a difference about the public markets are listed companies, right? But the fundamentals remain the same, which
Right.
means like the business needs to be solid based on a service for which a customer is paying to more, but going to pay you more compared to whatever your cost is. Right. So that's the base premise. Now, in case you're coming into the system trying to build a startup, keep that basic thing in mind. You can't just continue to throw free money into the system trying to get a client which is not going to pay you. Secondly, look at venture building as a long race. In case you are able to exit in 3 to 5 years, it's your luck. And plus, let's say you did something good. But in case you are a normal founder trying to build a company, take a long term bet because a business can't be built in 5 days or 10 days or a year. In case you need to scale up, you need time to hire, you need time to train, you need time to get your customers closed, service them, increase the base of the customer. So everything takes time. You can shorten the journey to some level, but not to a large level, right? So in case you build a really solid business, you need to really take time to build the foundations as well. So don't forget that this is the basics of building a business. Startup is again at some level a business only, right? So don't deviate from the basics of building a solid organization.
Right. So I would say I agree with you that it's a duration game, like we agreed on, right? And in a way, it's a contrarian way, right? Because we also discussed about founder mode, and then we are thinking about okay, building a processes, training. So there has to be some contrarianism involved and some balance. But like I said, I think founders start for multitude of reasons. Maybe it's social capital or validation, but it tends to become personal because ultimately after second year or third year it's your journey, right? uh, Even though you may have co-founder, but situations in your life and profession will keep evolving.
Sure.
And a lot of time in the moments when you're sitting alone working away, you may feel that it's personal, right? So I think in addition to duration, founders should make it personal, right? And attach meaning to it, right? Unless they attach meaning to it, I don't think that drive will sustain,
Right. Sure.
right? And I mean, one of the ways to do it is by fundraising, obviously seek validation. But if you can bring some meaning from within, then I think it becomes much more enjoyable.
Definitely.
Yeah.
Well said.
So thank you, Saurabh, for the conversation. And where can people find out more about AngelBay?
So you can look us up on our website www.angelbay.in.
Okay. And you can also reach out to us. We can connect you to Saurabh. Right? At least.
Thank you.
Thank you. Thank you, Saurabh.